Hello and welcome to today's financial report. Let's take a close look at what happened in the US markets overnight and what we can expect from A-shares today. The three major US indices closed essentially flat yesterday. The Nasdaq finished at 25,373.85, the S&P 500 at 7,489.72, and the Dow at 52,485.03. All three were basically unchanged, reflecting a market in a wait-and-see mode before making its next directional move, with trading volume notably light. However, the pre-market futures showed an interesting divergence. Nasdaq futures were at 28,467.25, down 0.6%, putting pressure on tech stocks. Meanwhile, Dow futures rose 0.74% to 53,310, and S&P futures were nearly flat. This divergence between cyclical and tech names points to a rebalancing of capital between value and growth. At the individual stock level, Nvidia was the strongest performer, up 0.91%. Tesla gained 0.63%, QQQ rose 0.51%, and SPY added 0.38%. Now let's look at the global macro picture. The 10-year Treasury yield came in at 4.68%, down 1.41% on the day, falling from 4.745% to 4.678%. This is the most important liquidity signal right now. A declining Treasury yield lowers the discount rate for long-duration assets, which supports valuations for tech and growth sectors. The VIX stood at 15.99, comfortably within the normal 15 to 25 range, indicating stable sentiment with no signs of panic. The US dollar index was at 99.78, staying below the key 100 level for a sustained period. This weak dollar environment is favorable for emerging market assets and supports renminbi stability. In the oil market, WTI crude was at $79.03, down 0.54%, relatively steady but on the soft side. Brent crude, however, tumbled 7.71% to $83.17, creating a notable divergence from WTI. This gap points to weakening demand expectations in Europe and will likely pressure the oil and petrochemical sector in A-shares. Gold was at $4,097.50, down 0.33%, a modest pullback from highs with no further escalation in safe haven demand. So here is the summary. Lower Treasury yields, a subdued VIX, and a weaker dollar form a liquidity-friendly core combination. But the decline in Nasdaq futures and the sharp drop in Brent crude remind us that demand expectations carry some hidden concerns. We characterize the current market as structurally risk-on, with risk appetite recovering moderately but not expanding across the board. Now turning to the renminbi and the external environment for Chinese assets. The onshore dollar-yuan rate was at 6.7410, with the yuan appreciating 0.16% on the day. The offshore rate was 6.7545, down a marginal 0.03%. The spread between onshore and offshore rates is about 135 basis points, with the onshore rate stronger, indicating solid domestic demand for currency settlement. The yuan remains in an appreciation channel, which provides positive support for foreign capital inflows into A-shares. On the US-China friction front, there are two verified developments. First, the U.S. Commerce Department's Bureau of Industry and Security has released a revised draft of export controls on high-performance computing chips. It is currently in the public comment period and is expected to be finalized within weeks. The draft aims to further restrict China's access to advanced semiconductor technology. Second, China has recently strengthened export reviews on certain rare earth materials. The market interprets this as a potential response to U.S. technology restrictions, but the news has not been officially confirmed and requires follow-up verification. For today's A-share market, we expect a lower opening. The main basis is the 0.6% decline in Nasdaq futures before the market open, combined with the weak close in A-shares yesterday, which dampens risk appetite in the tech sector. But the magnitude of the low open is expected to be limited, as the yuan's appreciation and lower treasury yields provide a buffer. For the Shanghai Composite Index, we expect range-bound trading with the core fluctuation range between 3,780 and 3,840 points. Yesterday, the Shanghai Index closed at 3,809.66, down 0.59%. After both heavyweight and growth stocks weaken together, there is room for a technical rebound in the short term, but falling Nasdaq futures will cap any rebound. In terms of sector focus, we are watching two directions today. First, optical communications and semiconductor materials within the AI computing hardware space. Lower treasury yields directly improve valuation tolerance for growth stocks.